everyone. It's a great honor to be here to share with you some of the observations I have about the use of cryptocurrencies, blockchains, and the development of decentralized finance. I wish I could speak Turkish language. Unfortunately, I can't, but I do have a number of great friends who are from Turkey, so it's a great pleasure. I know I only have 20 minutes, and so what I want to do is I'll try to avoid talking about things that you can read or see from media article, industry reports, and the like. I'll try to distill some findings from academic research, from research institutions at large tech firms. And what I'm going to focus on is the economics of using tokens. They could be blockchain based, although they don't have to be. And towards the end, if we still have time, I hope to touch on central bank digital currency and what are the key dimensions that we need to consider. But before we touch on money, cryptocurrencies, let's take a step back and think about why we need all this. Over the past few decades, we do see this transformation of our economy to become more digitized. Digital platforms are playing increasing roles in our economy, and there's a high demand for peer-to-peer interactions. And there's also the emergence of on-demand economy. Airbnb would be an example, Uber would be another example. One day I could be the passenger, the other day I could be the driver, right? We need this instantaneous across jurisdiction boundary interactions in the space. So what we really need is something that's functioning. Let me just make sure, okay, my slides is working. What we really need is infrastructure and functional trust within the system. And we need to be able to exchange value and information, oftentimes with people that are not revealing their identity, right? We are in an open system. And there are traditional ways to deal with it. For example, if we just want to exchange value, traditional centralized platforms such as eBay, Amazon, Alibaba, they've made payment innovations by creating an escrow account. If I'm a buyer, my payment is not going to the seller until I receive the delivery in satisfactory conditions, and then my payment is released. That's a centralized solution. So the recent development in decentralized ledgers or blockchains is really a relatively decentralized solution to the problem. I use the word relatively because it doesn't have to be fully decentralized, right? If we talk about Facebook's DAM, formerly known as Libra, that's a permission blockchain that's not fully decentralized, right? Many CBDCs are not decentralized at all, but they do provide a data structure that allows us to create functional trust within this system. You've heard a lot about cryptocurrencies, but there are many other applications of blockchains that I'm not going to go in detail. Recently, we've also observed the rise of decentralized finance, DeFi, and the two areas that have received the widest adoption, and many of you have touched on that, is stable coins. That's related to today's topic, payment systems, digital payments. The other area is just lending. People use the word yield farming, staking within this decentralized network. But why do we think it's going to benefit us in a more decentralized structure? Well, firstly, there is the avoidance of single points of failure. If we do everything in cloud computation and the cloud servers are all in one location, then a natural disaster could wipe the system out. So to avoid single points of failure, we have to do duplications. And duplication is costly, it's not free lunch. But it's helpful in guarding against single points of failure. It could be technical failures, it could also be economic failures, in the sense that if I want to bribe a judge of the court, it's very easy to do versus bribing an entire panel of judges, right? So a more decentralized structure provides certain robustness. Another reason we want a more decentralized setup is it allows us to avoid concentration of market power. Think about Bitcoin's structure, right? For keeping the record of transactions, people are competing by solving these cryptographic puzzles. No one has dynamic market power. No one is always going to have the power to append the next block, and that helps in reducing the market power of intermediaries of the platform. And finally, it's an infrastructure that allows us to exchange information and coordinate players. Just think about Medicare system. I live in the United States. I go to family clinic. My data is stored there, but data are siloed in that regard because these family clinic databases don't interact. Can we encrypt them in a certain way and still allow data to interact in aggregate to produce more information? That's a possibility. Medical field is one example. Financial reporting, auditing is another example. Over there, it's very much tied to one of the most actively developed areas in computer science, that's secure multi-party computation. Okay, so going forward, there are several areas that are very exciting. We're just seeing the possibilities of decentralized finance. The design of staking system is very important. We need to be able to fit off-chain, offline information, on-chain, online, through the use of oracles, and that's related to Internet of Things, artificial intelligence combined with Internet of Things. One thing that computer scientists and engineers have worked a lot is coming up with a set of rules and design a system. But from an economic perspective, there's also room to think more about how do we design a system to align the incentives and interests. That's related to mechanism and information design of platforms. And finally, what I hope to focus on today is about the use of tokens. How do you design the dynamic allocation of tokens? What exactly are tokens doing? If we replace it by some other forms of payment, be it fiat money or even central bank digital currency, would that change how a platform functions? Those are important issues. But before we delve into that, let's just take a minute to think about what are the categories of tokens. The SEC just broadly classifies it into security tokens versus utility tokens. If we go from a technical perspective, there are coins that's associated with native blockchains and tokens that's built on top of the native blockchain. You can talk about layer 1, layer 2, but from an economic perspective, what are the token categories? That's something I talk about in this book chapter. But one form of token is definitely general payment token. They aim to substitute fiat money. Bitcoin, Ethereum, CBDCs, they are all in this category. And over there, stability is crucial, right? Stability of price and return. Otherwise, it cannot serve as a unit of account. The throughput and capacity of these ledgers are also important. Otherwise, it cannot process as many transactions and it cannot serve as an effective medium of exchange. In that sense, Bitcoin is not a great medium of exchange because it just doesn't process as much transactions as Visa or MasterCards. But we can still think about it as a digital gold in terms of store value. And we might differ in our opinion whether how much we value gold or rare metals. Here is a similar situation. That's one category. Second category is platform tokens, such as Filecoin, which is decentralized storage, file storage, Definity that was launched about a month ago. That's about decentralized cloud computation. I'm going to talk more about that. But what's key here is it's not a general payment token. It's a token used only on that specific platform. And that specific platform is serving a function, specific function. That ties the valuation of tokens to the productivity of the platform, the functionality of the platform. And that's very important. Third category is what I would call product ownership tokens. I fly United Airlines, right? The mileage points I get would be a form of product token. Copper coupons is another example. Very recently, we've seen the rise of non-fungible tokens for digital art pieces. That's ownership token. We've seen tokenization of real estate properties. That's one category. And the fourth category is just security tokens that are cash flow based. That's something we know how to value because it's cash flow based. Discounted cash flow can give us a fundamental based valuation. And that's relevant for the regulator's decision on whether a initial coin offering is security token versus utility token, right? It depends on, in the US, is related to how we test, but more broadly is related whether it's deriving the appreciation from entrepreneurial effort versus pre-launching the platform versus decentralized contributors, third-party developers' effort post-launching a platform. What I'm going to focus on is the second category, platform tokens. And that's mostly based on two recent studies my co-authors and I have done. But let me just summarize what we find. So where does the value of token come from? Well, it helps facilitate transactions on the platform. So it's definitely related to the platform's function, right? If the platform is more effective, the matching of buyers and sellers are more effective, the tokens would need to facilitate greater transactions, and each token will be worth more. That's one pillar for token value. Another pillar for token value is related to supply and demand. Demand is coming from consumers. Supply is coming from the design of the platform, right? Whether we are adding token, we're increasing token supply at a particular rate, or we are buying back tokens to burn them by sending them to an invalid address so that no one can use it anymore. It's basically running monetary policy at the platform level, right? Those would all affect the token valuation. Why do we observe such a high volatility of tokens? Well, there could be fundamental technology uncertainties associated with decentralized ledgers. There could be speculation and behavioral factors that's driving the volatility. But one important aspect, by the way, I use red color to indicate that it's related to the first paper, first study, and blue color is related to the second study. One important source of volatility also comes from the endogenous adoption of platforms. Consumers can go on and off the platform easily. So that actually amplifies the volatility of token price or token price returns. And finally, the dynamic supply policy, right? Whether you're doing airdropping certain tokens or you are fixing a so-called inflation rule for a particular cryptocurrency or token, that's going to also affect volatility. In fact, if you burn token when the system is very inflated and issue more tokens when the system is relatively deflated, right? For a given level of productivity or functionality of the platform, that's a counter-cyclical policy that's going to help stabilize token value. More detailed information can be found in these studies, but here I'm just summarizing some of the key results. So essentially, for platform tokens, we can derive fundamental-based valuation. And as a platform owner or designer, you can also optimally design the dynamic allocation and supply policy, which involves observing the aggregate token supply relative to a productivity measure of the platform. That's going to be the decision variable, the variable for making our decisions in increasing or decreasing the supply of tokens in the system. What roles do tokens play? Well, many of you are already familiar that they helped bootstrap the community. They help accelerate the adoption. In fact, they also help stabilize the user base so that the user base doesn't fluctuate as much. But I encourage you to think more about tokens as a tool for running a platform or running a company, right? We already know tokens are used for financing purposes, right? Through initial coin offering, seasoned token offerings. Nowadays we have various forms of decentralized offerings as well. It's essentially a tool we can use to finance investments for the platform, to compensate for key personnel, or even third-party contributors, right? Miners would be an example, right? Mining, well, what is mining? Bitcoin or Ethereum is providing network security. People are making a contribution, and they are compensated with tokens, right? So these are all uses of tokens in the system. We can even think more about how tokens might help mitigate agency issues. They might also add to agency issues, right? So these are all functions of tokens that traditional security contracts or fiat money wouldn't quite work. Just to give you a key example why it's not the same. Think about a firm managing their cash reserve, right? Why do they manage the cash reserve? Well, they want to be flexible. When the opportunity is good for a particular investment or to hire more people, they can go in and do it right away. But when they hold cash or liquid instruments as a corporation, liquid instruments in the US is typically treasury bonds, they really don't have a say in pricing those instruments. But if a firm is using tokens and they are designing the supply policy, they are essentially determining the monetary policy within their ecosystem as well. And over there, there's much room for design and improving the efficiency of operations. Okay, I do have one example listed here. It's the Kin Foundation. But in the interest of time, let me move quickly to talk about central bank digital currencies. And if we have more time, we can come back. Okay. Here, I just want to illustrate that tokens are indeed used for the functions I described in the previous two slides. Okay. But let's take a moment to think about central bank digital currencies. So forget about blockchain for a moment. Digitization of payments is inevitable. I hope we're not debating that, right? PayPal was one example that's about digitizing payment systems. That's already done. In most countries, it's done by third private parties, private firms, not by central banks. Banks try to be more digital through electronic accounts, so on and so forth, but it's not the most efficient, right? To do an international transfer, it still takes me 3 to 10 days and a transaction fee. Is it because technology doesn't allow us to do it faster? No. But incumbent banks or financial service firms don't have the incentive to make it faster, right? If the money sits in the account, the bank earns interest on that, right, during the transaction, 3 to 10 days. So traditional systems don't provide the incentives to innovate in this dimension until the big tech firms, until the FinTech firms come in to disrupt this space, right? So that part we don't debate. And in fact, a lot of the time when we talk about digital payments, it's actually related to the data we collect from payments. Data play a big role. The governance of data, ownership of data are also open for debate at the moment. So that's something, as a business or as regulators, we need to think more about. But let's come back to CBDC. What is CBDC? It's essentially technology-enabled universal access to central banks' balance sheet for the first time. It was not something we could do easily before. It provides the access. It's available 24/7. It's universal, universal in the sense that banks, firms, households all have access, supposedly. It could use decentralized ledgers as the database system. It doesn't have to be. Remember, in the end, we want a functional system. It doesn't matter it's decentralized or centralized. Of course, if we are advocates for the ideal of financial democratization, we might argue, oh, we want a fully decentralized system. But other than the ideology aspect, as long as the system is reliable, resilient, functional, and reasonably pleasant for consumers, right? So that consumers are not squeezed by intermediaries or financial service institutions, that's fine. And also CBDC is often involving a national currency denomination exchange, right? It's one for one US digital dollar will be $1 US, right? One Chinese yuan, digital Chinese yuan will be one RMB. That's the features of CBDC. The key question to ask is who should run this system? One possibility is to have central banks run it. They have to decide whether they use tokens versus accounts. There are pros and cons. They can implement through two layers, right? Central banks still utilizing existing banks to implement a CBDC system. We could run it entirely on existing banks. Basically, banks issue their own tokens and digital currencies. JP Morgan made an attempt earlier, and that often involves a private-public structure and also a permission blockchain structure, meaning it's not fully open. A set of decision makers or governance committee members are going to verify the transactions and make the record of transactions. The third possibility is it's completely done by private parties. It could be based on permission blockchain. It could be permissionless, right? Ethereum or Bitcoin will be permissionless, but they have to be functional. Here are a couple issues that people often asked. Well, if a central bank is not decentralized, again, I reiterate, the goal is not to decentralize for the sake of decentralization. Sometimes you want decentralization in order to achieve certain functionalities, right? But if a centralized system or a hybrid does the job, I think that's totally fine. Do we need to use blockchain? Not necessarily. In fact, the Chinese government's DCEP, digital currency electronic payment system, uses blockchain, but not entirely, right? It's part of the design. Do we worry about bank runs on central banks? It could happen, but it's not necessarily a worse outcome than bank runs on commercial banks, right? Or just money leaving the country. That's a worse outcome. And there's also the question of, when the Chinese government introduced DCEP, for example, is that for global dominance? Is that for competing with the US dollar as a global currency? Part of that is true, but the primary reason is actually to regain control from private parties, such as Alibaba, right? Ant Financial, which is Ant Technology now, or Tencent. It was run, the payment system were owned and run by private parties. I think central bank digital currency is one way to regain the seigniorage right by central banks. Okay, and gradually, eventually, it might have implications for global currency dominance, but it's not in the immediate future. And finally, there are a whole array of questions on interoperability. When we use different CBDCs, how do they interact? The central banks have to set up their agreements. And in terms of regulation, in terms of capital control, I think those are all very open fields to explore further. I ran out of time. Sorry for running over for 2-3 minutes, but I'll stop here. Thank you.